Guys, this is crazy. I just got approved for a $50,000 loan. And the best part about it is that there's no tax returns, no documentations, no bank statements needed to be provided. And that bank that we're going to be talking about today is called Lending Club. And in this video, we are going to go over the exact process of how this works, the numbers and the data points that I use, as well as how this fits into your overall funding strategy. In my last video, I broke down how we were able to secure a client $900,000 in working capital along with 0% interest, funding altogether for 3 of his entities. And that video generated a lot of questions about the building blocks, specifically how we fund stages of a credit card strategy and working capital strategy before the bigger play comes together. So if you guys don't know who I am, my name is Felix, and I have a rule I apply to every funding products that we offer to our clients. I run it for myself first, and I want to know the process from start to finish, what it feels like, where it can fail, and what that approval logic actually is. We also work with over 1,500 plus clients in the past 6 years and has funded over $150 million in working capital for small business owners. And basically, I did a personal loan with Lending Club, and what I found was honestly surprising. So let's get right into it. And before I show you the application process, I need to explain to you why I even apply for a no-doc personal term loan in the first place. Because if you just grab this without understanding the context, you can actually damage your ability to get funding later down the line. So there are 3 legitimate reasons why I use personal term loans like this in a funding sequence. Number 1, it's to help season business checking accounts before applying for 0% business credit. When I set up a business checking account, for example, with Chase or Wells Fargo, I want anywhere between $5,000 to $10,000 sitting in those accounts before I apply for business credit. That cash signals to the bank that you're a real operator, not someone who just opened an account blindly just to apply. If a client doesn't have the cash liquid right now, a no-doc term loan comes into play. Number 2, it's speed. If someone needs capital within 24 to 48 hours, and we're talking about liquid cash, a term loan from Lending Club, SoFi, or even Discover moves a lot quicker than any business credit card. Because keep in mind, business credit card, once you receive it, you need to liquidate it. That also takes some time. There's fees involved. And by the time you finish, sometimes that real estate deal might not be there anymore, right? So speed is of the essence. You can literally go from nothing to 50,000 into your checking account by tomorrow. And number 3, as a top up after a business credit round, once we run a full 0% business credit card sequence and a client wants more capital, term loans is a great way to add additional 50 to 100,000 on the back end. So those are the right reason. Now the warning. Here is how people destroy their funding strategy with this product, and I've seen it many times. They discover no-doc loans, get super excited, and stack 4 or 5 of them at once. SoFi, Lending Club, Discover, Citi, boom, and they ended up with $150,000 in fast cash that they're pretty excited and happy about. And then 2 months later, they want to go for 0% business credit card and then get denied everywhere else. And the reason being is because one of these term loans shows up on their personal credit report. Multiple new accounts open in a short period of time would pretty much signals to the bank that you need capital urgently. And banks, as counterintuitive as this sounds, do not want to lend to people who look like they need the money. They want to lend to people that look like they could take it or leave it. So my rule behind this is 1 term loan at a time, 1 before a funding round to seed accounts, to season your business checking accounts. Never stack them right before you go for business credit. Now with Lending Club specifically, I haven't used them before. Someone in my network mentioned that they have great results with it. And per my process, I ran them before touching a client account. What makes Lending Club interesting compared to some of the other loans that I use, SoFi, Discover, or Citi, is the approval speed. I have processed a lot of these applications across different providers. Lending Club was the fastest that I've seen, and my application from start to finish only took about 45 seconds. I connected my bank account through Plaid, got a confirmation email, checked my account the next morning, and the $50,000 was there. And here's the best part. Genuinely surprised to me in my experience from what I've seen running clients do this is that roughly half the time, Lending Club does not issue a hard pull. They do a soft pull to verify your identity first, pre-approve you, and sometimes the full approval process without ever hitting your credit report as a hard inquiry. That is not guaranteed. It's not every time. I would say the probability will be 50-50, but when it does happen, it's a significant advantage because your credit profile stays clean for whatever comes next. So let me walk you through the application process as I did exactly in the decision that actually determined what you get approved. So now Lending Club does a soft pull at the pre-approval stage, and the soft pull pulls data to verify who you are. This sounds simple, but it is surprising that a number of applications fail because of this one process. Not because of bad credit, but because of mismatched information. Using your full legal name exactly as it appears on your credit report, not a nickname, not a shortened version, the exact match. Use a phone number that has been associated with you at least for a year, and they can verify how long a number has been tied to your identity. Use your personal email, not a business email. And once you had it for a while, a freshly created email address can even trigger a fraud flag in their system. I have credit qualified applicants that got denied at the soft pull stage because they use a brand new phone number or a nickname, and the system flags the inconsistency and rejects before even looking at your score. Step number 2, annual income, and this is the most important input in the application. Lending Club does not ask for documentation to verify your income, but what they do is calculate your debt to income ratio, and that calculation determines what you'll actually get approved for. So here's the framework. Out of all of your monthly debt obligations, your mortgage, rent, car payments, auto loans, credit cards, student loans, anything reporting on your personal credit, multiply that by 12 to get your annual debt obligations. Then add in your estimated monthly payment on the Lending Club loan itself. For a $50,000 loan, budget roughly $1,000 per month and add that to your annual total. Now divide that total by your stated annual income. Your stated annual income is the income that you list on your applications. That number needs to stay close to 40% and shouldn't exceed that in that case. So let's make this a little bit more concrete. Let's say that your current monthly obligations are $2,000 a month. That's $24,000 a year. You want to add the $12,000 of monthly loan payments with Lending Club based on what you're requesting for and based on the projection of what your loan payment is going to be. So let's just say it's $1,000 per year and it's up to 3 years. You add $36,000 in your total annual obligation. Divide that $36,000 by your stated income of $100,000, and that's 36%. You are under that 40% threshold. So now in this case, you are clear. If the same calculation puts you above a 40%, you have one lever by increasing your stated income until that ratio drops below 40%. So I have clients that state $150,000, $200,000, even $250,000 annual income depending on their debt load. What matters is the ratio, not the raw number in itself. The application asks why you want the loan, and this matters a lot too. Do not put loan consolidation, debt payoff, or anything that signals you're using to clear up financial problems that you currently have. That framing will tell the lenders that you're under pressure, and pressure equates to risk. Put major purchases. I personally did home improvement, wedding, vacation can also be a different options. Sometimes that frame you as someone who doesn't need the money and you just want it for something positive. The psychology here mirrors exactly what I said about banks not wanting to lend to people who look desperate. You want to frame yourself as someone that's comfortable, and the loan purpose field is the opportunity to do exactly that. Now, let me give you the variables that happens after you submit, because not every application goes the same way, and knowing how to respond to that separates someone who gets funded and someone who actually gives up. Variable one is they might ask for documentation, sometimes, not always. Lending Club will ask for a pay stub or bank statements after you do a soft pull pre-approval. And if you have it and supports the income that you stated, do provide it. If you don't or it contradicts your stated income, do not submit anything. Instead, what you want to do is wait for 30 to 45 days and reapply. I have done this for clients, and the first application triggered a document request, which we declined to submit. We waited for a month, close to 45 days, reapply, and got a no doc approval. Sometimes in their system, it resets the underwriting criteria and it works. Variable two is by dropping the amount that you're requesting for on that personal loan. Here is the move I use multiple times. If you apply for a $50,000 and they ask for documentation, reapplying, requesting for $40,000 instead, a 20% drop. Lending Club system appears to have an internal no-doc ceiling for each applicant based on soft pull profiles. At $50,000, you might trigger a documentation requirement, but at $40,000, the same applicant might clear a no-doc process. And I push through approvals due by simply adjusting the number down by 10% or by $10,000, which is 20% from the $50K requested amount. It's not guaranteed, but I've seen it work enough times to always try it. Variable number three, the hard pull question. Let me show you how this actually fits into a complete funding sequence, because Lending Club on its own is a tool. The strategy is how you deploy it. Here's the sequence I use for our clients starting from scratch who wants to build significant. Number three, the hard pull question. As I mentioned, about half the time, Lending Clubs does not issue a hard pull, and the application use Plaid to connect your bank account. In many cases, that plus a soft pull is all they need. If protecting your credit profile for an upcoming business credit card round is a priority, Lending Club is one of the cleaner options precisely for this reason. Funding towards their overall business funding strategy. First, one no-doc term loan, Lending Club, SoFi, or Discover, depending on your credit profile. Use that cash to seed business checking accounts with the banks that you're targeting for the 0% business credit card. Put anywhere between $5,000 to $10,000 into each of those accounts and let it sit for 7 to 14 days. Second, with those accounts seasoned and a banking relationship established, apply for their 0% introductory APR business credit cards. And this is where the bulk of your capital really comes from. I help clients get up to $100,000, $300,000, and even one up to $900,000 in 0% business credit card using this foundation. Last but not least, after the business credit card round is completed, if the client needs additional capital and their profile can actually support it, a second term loan on the back end will add another $50,000 to $100,000 more without touching the 0% structure. So that's the complete sequence. And the term loan is the initiation. The business credit is the engine. Use it in that order. You get both the speed and the volume at the same time. Quick note on who this works for, because Lending Club no doc approval is not for everyone. You want to have a FICO score above a 680 in order to get the best results. Below that, you might still get approved, but the rates increase significantly and the no doc threshold drops. Your debt to income needs to be manageable, and as we discussed, you want to stay below 40% with accurate or reasonable income figures. If your credit is in the 640 to 680 range, there are other no doc term loan providers with more flexible underwriting. Upgrade and Avant comes to mind, but the rates will be higher and the no-doc experience may be a lot less clean. The credit profile works comes first and then the term loan. If you've been watching my channel, you know that I talk about building business foundation, business credit foundation before going for any of these products. That advice applies here too. Lending Club at 680 plus is a very different experience from Lending Club at a 640 FICO score. So here's the summary. Lending Club is one of the fastest, cleanest, no-doc personal term loan options available right now. The application is around 45 seconds if you have your information ready. They use a soft pull for pre-approval. In roughly half of the cases, there's no hard pull at all, and the money hits your account within 24 hours. The two things that determine your approval: your personal information must match your credit profile exactly. Your debt to income ratio must come down below 40% based on the income that you state. Get those two things right, and the approval process is as smooth as any loan products I've personally used. But use it strategically. One term loan in the right sequence before a business credit card round, and not stack a bunch of loans that will flag your file before you can go for bigger capital. If you personally want our firm and myself to map up your full funding sequence, what that looks like, which includes term loan, business credit, SBA, acquisition financing, or just different revenue-based funding out there for businesses, that's exactly what my team does on a strategy call. The link is in the description. It's free, and I will save you months of trial and error. Drop a comment down below if your credit score range is 640, 680, 700 plus, and I'll tell you in the comments which loan provider I recommend specifically for your FICO score. And keep in mind, I read every comment. Subscribe if you're new, and in the next video, I'll break down the full 0% business credit card sequence that the term loan feeds into, and you don't want to miss this one. Again, my name is Felix, and I'll see you in the next one.